What's going on, guys? Most of you guys hear the term passive income in real estate, but very few understand how passive investing actually works. In fact, most of what people think is passive really isn't. Today, I'm going to break it down exactly how passive investors make money in senior living and multifamily properties. My name is Roberto Carabetta. I'm a senior living and multifamily operator, and I help investors earn real passive income by partnering on larger commercial real estate deals. This channel, it's all about making passive investing easy to understand. Now let's get into it. What passive investing really means? Passive investing means you invest capital into a professionally managed property and the operator handles everything. You're not dealing with the tenants, the repairs, staffing, or day-to-day decisions. Your money's working, but your time doesn't. I'm going to explain two different sides of the token. One is an LP, limited partner, and one is a GP, a general partner. The passive investor providing the capital is the limited partner, the LP. The operator who finds a deal, underwrites a deal, raises capital, manages the renovations, oversees the whole operation, and executes on his business plan, that's a general partner. How money flows in the deal? It's simple. Every property generates income. In multifamily, it's rent. In senior living, it's rent plus care level plus service fees. For that income, we pay operating expenses like staffing, food, utilities, maintenance, management. What's left over after the income minus the expenses is called the net operating income, NOI. After the debt is paid, whatever mortgage you have on the property, the remaining cash flow is distributed to investors. This typically happens on a quarterly basis. Some deals could be monthly, some deals could be semi-annually. Traditionally, it's on a quarterly basis. The LPs, the limited partners, reap the rewards. They get paid first on any distribution. Let's talk preferred returns. A preferred return is the return the passive investor, the LP, receives before any operator, the general partner, participates in profits. Like I said, the limited partners get paid first. Common preferred targets range from 6 to 10%. I try to hit a 7 or 8% target on a multifamily and a 9 or 10% cash on cash return on a senior living facility. This structure protects the investors and it aligns with incentives. After that preferred return, profits are split between the LPs and the GPs. So the preferred return, that limited partner gets that first percentage, that first, call it 7%. After that, it's split. It could be 80%, 20% in favor of the LPs. It could be 50-50, 60-40, whatever the operator, the general partner decides, and that's in line with the limited partner's investment criteria. This simply means passive investors receive the majority of the upside. Because they're providing most of the capital, they get rewarded. Essentially, they're in second position after debt. The general partners are in third position. They get paid at the end. Slight difference between senior living and multifamily returns. Multifamily is generally more predictable with steady demand, stable cash flow. Senior living, it's more operational heavy. It typically produces higher cash flow due to the care services, the level of care, the higher rents, but then you have that layer of real estate on top. Both assets have strong long-term demand, but it comes down to the risk tolerance and the investor's goals. I personally like the risk to the reward appetite of a senior living. In today's environment, in today's market, senior living has huge upside potential as an investment. There is a risk associated with it, higher operating expenses, but the risks, to me, outweigh the rewards. All right, a simple $100,000 investment. I'm going to try to break down to you very simple. If someone invests $100,000 into a deal and there's an 8% preferred return, that's about $8,000 per year in a projected cash flow. Over the life of the investment, the investor receives distributions, builds equity, and participates in any profits when the property is either sold, refinanced, or any other capital event. That limited partner gets their percentage share paid out first before the general partners. Yes. There's always fees associated with doing business. These fees are not hidden. The operators like myself disclose everything, all in the legal documents, all in our pitch deck, all in our presentations. We disclose every single fee that we're charging. These fees can include acquisition fee, asset management fee. This exists because operating larger properties takes time and experience. From finding a deal to actually closing a deal, when that deal is not even making money and is not even under our ownership, could take anywhere from 3 to 6 months. That's hard work on the due diligence, structuring the finance, finding the finance, underwriting the deal, finding the capital. All of this behind the scenes work, talking with legal. That takes time, that takes hours, and that deserves a fee. So that acquisition fee is paid at the day of close, and it goes into the pockets of the general partners. Strong operating experience, a clear and realistic business plan, conservative assumptions, strong markets, reasonable debt, and transparent communication is all that's needed when investing in the operator, just as much as it is when you're investing in the real estate. It's not all about the real estate deal. It's about the operator, how he's going to handle the business plan, how he's going to handle the investors, and how he's going to make this succeed. Believe in the operator as much as you do in the real estate. Why LP investing is truly passive income. Passive investing allows you to scale without giving up your time. You leverage the experience of an operator. You gain access to cash flow, tax advantages, huge tax advantages, and you're building long-term wealth without even managing the properties yourself. The general partners manage every single aspect of the property. The limited partner is truly passive. They get quarterly or monthly updates along with their distributions, but they don't have any headaches or phone calls at night or any time-consuming actions that lead to managing this operations. If this helped clarify passive investing, like the video so other people can see it. Comment below if you want me to break down a real deal with actual numbers. Subscribe for more content about where I talk about senior living, multifamily, investing, and how this commercial real estate industry is an excellent way to earn passive income and build your generational wealth. Subscribe and like my video, guys. Thank you.